So, are you ready to make your crypto actually start working for you? Today, we're going to dive into two really powerful but pretty simple option strategies that are all about generating income from your digital assets. We're going to cut right through all the complicated stuff and just focus on the practical steps you can take. You know that feeling, right? The constant stress of trying to time the market. Is it going up? Is it going to crash? I mean, what if you could generate returns without having to be a fortune teller? Well, that's exactly the power behind the strategies we're going to unpack today. Okay, before we dive in, we have to do the standard but very, very important disclaimer. Look, this is all for educational purposes. Trading options has some serious risk, and it is definitely not for everyone. This isn't financial advice, so please do your own homework. All right, first things first. Before we can even think about using these tools, we have to know what they are. So what in the world is a crypto option? The easiest way to think about it is like it's a reservation for your crypto. It gives you the right to buy or sell at a price you've locked in. But, and this is the key part, it's not an obligation. You have the choice. And that flexibility, that's what makes options so interesting. And this right here is the absolute core of our income strategies. See, we're not buying the options, we are selling them. When you sell an option, you're basically selling that reservation to somebody else. And for doing that, you get an instant cash payment. It's called a premium. Okay, so let's put this into action with our very first strategy, the cash secured put. Just think of this as getting paid to place a buy order for a crypto you already wanted, but at the price you wanted to pay. So let's paint a picture. Imagine Bitcoin's trading at $60,000. You're feeling pretty good about it long term, but you think it's a little pricey right now. You've got your eye on a better entry point, maybe something like 55,000. If it hits that price, you're all in. So instead of just setting an order and waiting around, you can actively generate some income. First, you pick your target buy price, $55,000 in this case. That's called the strike price. Then you sell a put option at that level. And for doing that, boom, you instantly collect that premium we were just talking about. And here's the payoff. Just for agreeing to buy Bitcoin at the price you already wanted, you could collect an immediate premium of, say, $800 per contract. That is cash in your account today. So what happens next? Well, there are really only two ways this can play out. In outcome A, Bitcoin stays above your target price. The option just expires, you don't buy any Bitcoin, and you simply keep that $800 premium as pure profit. Not bad, right? In outcome B, the price does drop, and you get assigned to buy Bitcoin at $55,000, which is exactly what you wanted to do anyway. And here's the bonus. Your real cost is now $54,200 because you get to subtract that $800 premium you already collected. Okay, but what's the catch? You gotta understand the risk here. What if Bitcoin doesn't just dip, but it completely crashes down to, say, $40,000? Well, you are still obligated to buy it at $55,000. And that's why this strategy is only for people who genuinely want to own the asset at that price and are ready to hold it for the long haul. All right, let's flip the script. What if you're already holding crypto and you want to make it, a little more productive? That's where our second strategy comes in, the covered call. This is all about getting paid to hold. So, new scenario. You're holding one Bitcoin. The price is sitting at $60,000. You're not really looking to sell just yet, but you kind of think the price might just trade sideways for a little while. So the question is, how can you generate some cash flow from your holdings while you wait? The action plan here is really simple. First, you pick a price where you'd actually be happy to sell. Let's go with $65,000. Then you sell a call option at that price. This basically gives someone else the right to buy your Bitcoin if it hits that level. And just like before, you get paid that premium instantly. And for making this agreement, you could instantly pocket a premium of, for example, $600. That's income you earn today just for setting a future price target on an asset that you already own. Again, let's look at the two potential outcomes. In outcome A, the price never gets to $65,000. Perfect, the option expires, you keep your Bitcoin, and you keep the $600. You've just successfully generated yield. In outcome B, the price surges past $65,000. Your Bitcoin gets sold at that price, you lock in your profit, and you still keep that original $600 premium. It's a win-win. But here's the trade-off, and it's a big one. What if Bitcoin doesn't just go to $65,000? What if it moons to $80,000? Well, you've already agreed to sell at $65,000, so you miss out on all those extra gains. You're basically trading that unlimited upside potential for immediate steady income. Understanding these risks is so critical. It is literally the difference between being a strategic investor and just being a gambler. So let's break them down one more time. Yeah, let's be totally clear here. With the cash secured put, you risk being forced to buy an asset while its price is dropping like a rock. With the covered call, you risk capping your profits right before a huge bull run. Both of these strategies demand patience and a really clear, long-term plan for your assets. So, how do you choose? Which one is right for you? Let's boil it all down to a final takeaway with a super simple strategy cheat sheet. It really is this simple. If your goal is to buy crypto at a lower price, the cash secured put lets you get paid while you wait. If you already hold crypto and you want to generate some income from it, the covered call is the tool for that job. I think this quote just gets right to the heart of it. These aren't lottery tickets. They're not a get-rich-quick scheme. They are systematic tools for investors who are playing the long game, and that requires both discipline and a whole lot of patience. So we're left with this one question. The tools themselves, they're neutral. But the results, they depend entirely on the person using them. So are you going to use them with a disciplined plan to build wealth over time? Or are you just going to use them to make a speculative bet? The choice between being an investor and being a gambler, well, that's ultimately up to you.